Tax tips for agricultural producers, brought to you by Farm Business Consultants.
My goal in the next hour for each and every one of you is that you take one key or two key elements on things that I'm going to be discussing. I'm going to try and not go really quickly. There's a lot of information here, so I'll try and discern it as best as I can so that you can gain some knowledge. We will be taking some questions at the end, so please make some notes and hold your questions to the end, and I will do my best to take those questions. We're going to keep it within an hour, so we've got a lot of information to get through, so without further ado, I'm going to get started. I want to start by kind of telling you guys a little bit about FBC, just so you have a better idea as to why you're listening and paying attention today. We've been specializing in agriculture for 66 years, starting as far back as the mid-50s. We are considered to be like the tax technology leaders in tax optimization, the only tax provider who has an app where you can upload your receipts and view your tax returns on an app and all that good stuff. We are Canada's only year-round membership model, meaning that we don't just specialize in doing your tax return at the end of the year. We kind of hold your hand throughout the year as you're making your buying decisions and planning decisions. We're with you, and we've got 300 plus highly trained and motivated staff with a single focus, which is to make your life less taxing and have you taxed at the lowest possible rate. I talked a little bit about the membership tool. We do have an app and Cashew Online, which also helps you with bookkeeping. But again, with the app, it's really neat to be able. Sometimes you're going into the bank and they want to look at 2 years, the tax return 2 years ago, or they want to see what your trial balance looks like, or well, you can just get out your phone, go to your FBC app, and share all of that information without, I have it at home, I don't have it with me, we'll have to get together again. With that app, you can just call it up with whatever it is that you're looking for. Okay, so we're going to give you 12 tax tips for agricultural producers, and this is where I'm hoping that you're going to take maybe one or two things away. I will try to explain it as best as I can and have you guys kind of walk with that information. The first one is obviously determining if cash or accrual accounting is better for you. So the key part with this is there are benefits to cash accounting. So in cash accounting, your expenses are as they go. As you all know, your inventories, where you can do some pre-buying at the end of the year, deferrals, different things like that. And then obviously accrual accounting isn't as flexible, for example. But what you should do in this situation is speak with a tax professional who will give you more information on which form is best for you. Okay? The second one is to keep good records. And this is one that always either provides a roll of the eyes or, well, I'm not the greatest at keeping good records, so how do I go about doing that? What should I do to keep good records? And what I've always suggested is to keep it really simple, put aside 30 minutes per month, okay? Get yourself an accordion folder, and then put the expenses in the different compartments. And if you do that once a month for 30 minutes, you will at least have everything categorized so that at some point you can go ahead and put them in a spreadsheet, in some sort of report, because the days of having the shoebox are no longer allowed from a CRA perspective. They, about 4 years ago, set up what's called a minimum records rule. And the minimum records is basically just as it says, minimum records. So at the very least, at year end, they need to be in some sort of spreadsheet file of some kind. They're still allowing manual records, but at the end of the year, they need to be in some sort of tally. And you can't just have it in a shoebox. So keeping good records is important. In an event of an audit, the good records is what's going to really protect you and save you. So just to review, spending 30 minutes every month, take out your receipts of the shoebox or glove compartment and wallet, organize them into your accordion binder, and also go online and get your credit card transactions to your tax organizer. The convenient part about this now is if you print off your credit card bill, you'll see that they kind of categorize your expenses now. So it really, really helps with your tracking of expenses. So printing off your credit card monthly to your tax organizer, very, very beneficial when it comes to putting everything in an Excel spreadsheet. Also, ensure that you're keeping it for a minimum of 6 years. The paper ledger or electronic bookkeeping software is preferable. Again, they're still allowing the paper ledger, but they must be in a ledger report by year end. And also make sure that you keep the original receipts or the digital copies, because again, in the event of an audit, this is kind of like your full safe backup. Okay, we'll move on to number 3. Be aware of all tax deductions that are available to you. So in a lot of cases, tax deductions from farmland and farm property, so things like fencing expenses, all of those items and all of those deductions that take place in the farm operation are often things that sometimes, because they're part of your daily operation and it's kind of second nature to do, sometimes you fail to keep the invoices and keep track of those expenses. Tax deductions related to farm machinery. So whether it be the repairs to the machinery or fuel, insurance, all of those things are part of your tax deductions. And when you start to add up all of the HST, GST, PST that's involved in those expenses, it's extremely important that all of them are captured. Depending on where you purchase some of these, so whether it be repairs or fuel, sometimes the HST, GST, PST is in the cost and not always is it broken out. So ensure that that HST, PST, GST is broken out so that when you're doing your return, you get all of that back. That's an input tax credit. So that's dollar for dollar back in your pocket, which increases your refund, whether it be quarterly or monthly, whenever you decide to report your GST, HST, PST. Tax deductions related to supplies. So you guys all know that those parts, some of them have the tax in them, some of them don't. Ensuring that you continue and record those supplies. One of the tricky parts I always say, and this part sometimes will kind of hit home to people who are doing their own bookkeeping. At the end of the day, you're really the accountant here. And the reason I say that is because if an expense is not tracked, then it's really, really hard for someone to know that it exists, if that makes sense. So you and the importance of you tracking your expenses are incredibly important. So that's why the accordion folder helps. Anytime you get an expense, throw it in there. And then that would help in ensuring that you don't miss those expenses. Okay? Tax deductions relating to bank insurance and accounting fees. So most of you will know that those items should be tax deductible, but what happens is we're so busy tracking our expenses that we do on a day-to-day basis that when we get our bank statement, we don't tend to track the expense on bank fees. For those of us who've got insurance, those expenses will come through your bank fee or through your bank statements. There's certain charges that you get that you should go through your monthly statement, and there won't be an invoice necessarily, but there'll be tracked expenses that comes out. So the service charges will be there. Your insurance will usually be there. Different expenses that don't have a receipt but happen on a monthly basis and automatically come through your bank account. So make sure you're capturing those. And obviously your accounting fees. Another key thing is your interest on your line of credit. Over the years as a tax expert, I've noticed that gets missed quite a bit. It's just something that you don't necessarily think of. But interest on your line of credit is tax deductible if it's being used for your operation. Now, if you've got a line of credit that you sometimes use for personal reasons and for farming reasons, then a portion of that interest would be tax deductible on that line of credit. Again, make sure that you're speaking with your tax provider to make sure that they're optimizing the expense on that. Capital cost allowance classes. So you guys may know that it's on your tax return, but you may not know that they're tax deductible at different rates. So for example, a tractor will be deducted at a different rate than, say, your farm vehicle. So these expenses will pool in what they call the CCA allowance. One of the key points of advice as someone who does proactive tax planning, don't just every year assume that a capital cost allowance expense should be used. From a tax perspective, there are years, say that your year doesn't go as well as some that are much better than. When you have a really, really good year, obviously the CCA allowance should be used. But if you had a subpar year, whether it be to it being very, very dry or too wet, you may not want to use that capital cost allowance because you're not very taxable and you may want to save some of that pool. Again, that's a conversation that you should have with your tax provider because that's just about being proactive as opposed to using an expense. Think of it this way. Using a $6,000 expense in a year that I pay zero tax. Why would I still want to use that $6,000 up? Unfortunately, in the accounting world, it's very common to do it that way, whereas you should be looking at it on a year-to-year basis. Should it be used? Should it not be used? Here are the pros and cons of using it this year. So that's a real key thing to keep in mind, and you should be seeking advice of a tax provider for that to get the biggest bang out of your buck. Number 4, track your mileage. So this is really, really important. This is really, really important because if you don't track your mileage, CRA could disallow all of your vehicle expenses. It's a real pain in the you-know-what. I realize that and I understand that. Back in the day, some of you on this call will remember the frustration of keeping the little notepad on the visor and, I'm going to church, it's 6 kilometers away. Like you had to go through that exhaustive process. And because it was so frustrating, not all of us kept good mileage logs. Well, now there's apps available that will do it all for you. They will track how many kilometers you drove. It will ask you, is this business or pleasure? And then at the end of the month, it will give you a statement of the kilometers driven, what they were for, how much business, how much personal. All you do once a month, print it off, keep it in your records. There's your mileage log. And in the event of an audit, and if they ask and they go after your vehicle expenses, they will ask you for your mileage log. And if you don't have one, they could disallow some expenses that you and I both know are extremely legitimate. But because you don't have the mileage log, they could disallow it. So do yourself a favor. Mile catcher's on here, but there's plenty of them out there. I'm not going to endorse one or the other, but you can just go out there, get yourself a mileage tracker, and don't worry about that piece. Use the livestock tax deferral provision. So depending on, and again, this is something I'm going to share, and some of you on this call will have already been through that. And depending on the type of year you have, if sale prices are up, sale prices are down, disease running through your barn, whatever the case may be, make sure that you use that deferral provision. What does that mean? Well, by being proactive with how your taxes are being done, and remember, farm tax is very, very different than non-farm tax. In fact, some small business owners have kind of accused farmers for years and years of, they can do taxes so many more different ways than we can, and they get so many benefits and all these and other. But the reality is that there is a lot of flexibility on how a farm tax return can get put together. So make sure that you're using that proactive approach, and the livestock tax deferral is an example of that. Take advantage of deferred cash grain tickets. You guys all know what this means. Where you purchase, someone purchases your corn, your grains, and then coming up with a tax plan to take advantage of what you can do to claim that income in that year, or possibly, depending on what your tax situation may or may not be, put yourself in a position where you're using that grain ticket where it's optimal from a tax perspective. Okay, again, tax provider, your accountant should be able to help you with that. Someone who specializes in farm will be a lot more familiar with this with someone who maybe isn't. Farm tax is complex because of all of those provisions and exceptions that are there, but you got to make sure you're taking advantage of it. Open a tax-free savings account. This is about tax. This may not be necessarily about farm tax, but every year, the government, for a number of years now, has allowed us to open up a tax-free savings account where any of the interest earned in that account is tax-free. So if you don't have one, there's no harm in you getting one, because any interest earned within that is tax-free. Now, some of you on this call may have financial advisors who have you doing some pretty creative things with the tax-free savings account, and I'm certainly not going to disagree with any of those, but it is important to utilize it because, well, how often does the government provide us with anything that's free? So do that. Take advantage of RRSPs. This one I will caution you on, though. Not everybody is a huge fan of RRSPs, and I understand why, because if they aren't done correctly, then you're losing the benefit of the tax that you're saving within an RRSP. So there's some people who do RRSPs the same amount every single year, and they're doing that from a retirement perspective and not necessarily from a saving tax perspective. Well, there's going to be some years that if you're taking out X amount of dollars, it may not be tax advantageous to do so. Whereas if you've got yourself somebody who is familiar with the financial side as well as the tax side, you can actually maximize and take out the exact amount of RRSPs, which saves you that proper amount of tax for that year. So if you've got a tax planner, they will tell you what that a perfect amount is to the penny that you're maximizing your tax savings on an RRSP. Okay? Talk to your financial person for a little more advice and guidance on that, but certainly something you should be taking advantage of. Spousal RRSP also, that's an option, because it's usually where it comes into play where the person who earns the least you can take out a spousal RSP and have that individual. So again, I will share that information with you, but different situations that would be beneficial. So rather than getting into how you should do it, I'll just show you a little bit of an example on how that actually works. So on the spousal RSP, if your income, your net income is $100,000 and you contribute $10,000 for your RSP and then make a spousal contribution of $8,000, you'll notice that the RSP will stay under your name, but your taxable income will not just include your contribution, but the spousal one as well. So that's pretty neat and something that should be looked at. Again, talk to your tax professional and or financial person to kind of ensure that you're getting the biggest bang for your buck, because tax rates do matter. Time capital gains and losses to overall your tax burden. So I'll give you a perfect example of that. Whether it be capital gains through a farm sale or capital gains through investments, whenever something's sold, there's a taxable capital gain that comes with that. Well, I remember when I was a tax advisor, unfortunately, you might all remember about eight to 10 years ago, the market went for a real tailspin. And the majority of the people who were affected were those who had no choice but to cash out their RSPs. Other than that, if you didn't have to cash anything out, it's already come back to where it was. But what we did when doing the year-end tax plan, so this is where we would sit down with someone prior to their year-end. So if it's December 31st, for example, that's their year-end. We would sit down with them, say, first week of December. And then what we would do is look at their capital gains and then plan their capital losses, investments that wouldn't be making a recovery or capital losses that have been reserved, and then use them in those years to reduce your tax burden for that year. This strategy is only used and can only be used if you have a proactive tax approach, because those decisions can't be made once that December 31st stub is done. You can't then make some of those retroactive decisions. So it's really important to be proactive and stay ahead of the curve on that one. And if you don't, unfortunately, you're missing out, and we don't want that. Have a risk management plan. So, and risk management plan, they could mean a number of things. Crop insurance, obviously, is a risk management plan. Being enrolled in the government's stability program. It's the only program that they now have. Some of you on this call who've been at this for a long time will remember the grains and oilseed and NISA and CASE, and there's so many over the years, and for now it looks like they've kind of been with the AgriStability and AgInvest now for a couple of years. But have a plan. Make sure that you're in a position where a terrible year doesn't cripple you, because you've got, and we always say, well, I can't really plan for a bad year. You're right. But if the strategy is there and you take out a little bit of protective insurance, for example, then you're in good shape. Some take the opinion of, well, I don't want to get the insurance that I'm asked to get. And those are decisions that as farm owners and as business owners, you get a chance to make. But sometimes if you've never used your insurance, that's kind of a good thing, because things have gone really well. No different than having car insurance in some ways, right? If I never have a claim, then everybody's safe and all is good. And a lot of you on this call are really good at doing this. Kind of, you've always had one. It may not have been on paper necessarily, but you've always some of those down times and kind of learned from it and have picked up on some fail safes to to know if something's not going well, how to improve and how to lower your risk. That's important. So there is some management programs through the government I talked to you guys about, but they've got one that's really is kind of on the innovation side. So if you're in this innovation category, it also supports competitiveness and market development for Canadian producers and processors, and it's called the Canadian Agricultural Partnership. That policy includes risk management programs for farmers, and then obviously you see the AgStability and Agrilnvest that I talked about. One of the downsides, and a lot of you listening to this right now have experienced some frustration or possibly have with the government farm programs. It's frustrating sometimes, and I almost feel like they set it up so complicated that not many people can understand it. The one thing that I will tell you is if you understand these programs well, or your tax provider does, you will often get benefits that, say, the farmer down the road or across the street doesn't receive. I can tell you that from experience, and I can only share the information from 2 years ago because they haven't produced last year. But just to give you a little bit of an example on the power of understanding these programs, FBC clients made up for about 30% of the people enrolled in the AgStability program. However, FBC members had benefited with 71% of all of the monies. So what does that mean? Does that mean it's not that we know somebody important, it's that we understand how to produce the report, which is going to make you eligible for those proceeds. And it's not a one and done thing. It's a program that you have to be in consistently for. So sometimes there's no point in being in it, and we advise you to not be in it, because it doesn't look like with your operation you're ever going to get a benefit out of it. And then there's others that should be enrolled in the program based on their eligible income and expenses. So just get some knowledge on this because it's important. You'll probably be aware of people, you may have heard it, I call it the Tim Hortons coffee shop conversation, where you'll say, geez, I know of a guy down the road whose operation is very similar to mine, and he keeps bragging about this $23,000 got out of the program last year, and he got another 17 this year, and I've been in the program and I don't seem to get anything. Some of you have heard of that, and unfortunately it's a reality because how you put the application together is important. So if you're doing it yourself, you may want to get some advice on how to put it together and how to do it properly. Okay. Consider corporation. That's tax tip number 12. All right. Well, what does that mean, consider corporation? I can become incorporated in 20 minutes, just going online, getting my incorporation certificate, and that's as hard or as easy as it might get when it comes to incorporation. Well, the key word in this is consider, because there's advantages and disadvantages to incorporating, right? It's not as easy as just going online and getting incorporating. Anybody can do that. Anyone with a credit card number or a bank account number can go ahead and incorporate their business or farm. But doing it properly and whether it should be done is extremely important. And this is where the conversation needs to go on advantages to then counter it against the disadvantages. So some of the advantages first are limited liability. They can't go after you personally. Well, they could, but a very small portion they can go after personally. A corporation extends beyond the life of the shareholder. So what does that mean? So if you're setting up a family corporation, if one of the shareholders pass away, the corporation stays intact. You avoid a lot of forced sale of assets that would be subject to tax and things that you don't want to necessarily be forced into doing. And some of you on this call may know of people who unfortunately didn't have an estate plan and they passed away and everything was frozen for several years because they didn't have anything like that. Children couldn't get their, it just got stuck for a number of years. Well, having it be an incorporation prevents some of those unfortunate things where you have to sell because of death. Income tax deferral. So corporations, particularly farm corporations, have a fairly significant amount of tax benefits, and income tax deferral is one of them. Transferring the business, should ever that be something that you want to do, and I'm not saying that you may want to transfer it to the kids, generational transfer of the farm corp, because you'd like the kids to be involved in the farm, and one day it makes sense to transfer the business, perhaps maybe while you're alive, to minimize some of the tax complications of those things. But that's another advantage. Income control. Hey, look at in simple terms, the income tax rate for corps is much lower. That's usually the benefit that everybody knows about. Like on the personal side, if you're in a proprietorship or in a spousal partnership or in a partnership, your income tax, depending on your level of income, could be as high as 50%. Well, the tax rate for corporations, you could profit up to $500,000 and you will never be paying more than 12, 13, 14% of tax. It's different for different provinces, so that's why I'm kind of giving you a few different numbers. But let's look at it this way. If you profit $200,000 in a partnership or proprietorship, you're probably going to be paying pretty close to $100,000 in tax. If you're profiting $200,000 in a corporation, well, the math is easy. You're only paying about $32,000 in income tax. So that's usually the biggest benefit, but there's more. Obviously, the income splitting where the shareholders are getting paid. So personally, the shareholder may be splitting the $100,000. You're taxed personally 50 on one shareholder and 50 on the other, instead of receiving a dividend of the full amount. The lifetime capital gains exemption in a corporation, that's pretty huge. And then you've got to compare it to the disadvantages. It's expensive. It's a lot more expensive to have corporate taxes completed by a tax provider than it is a non-corporate return. You usually have to pay a lawyer. You've got to pay for a minute book update on an annual basis. There are some added costs associated with incorporation, so you need to consider those. Another tax return seems like it's more complicated. So again, another tax return to have to keep, hold on to, store, whatever the case may be. But to some people, that is a disadvantage. There is increased paperwork. I will tell you, though, that the paperwork side, the only increased paperwork on your side is really having to have the minute book updated. Because the increased paperwork side, it's almost like the accountants got the increased paperwork to have to do on your behalf. But I would say that it's increased compliance because you've got a minute book that has to continue to be updated. There are no personal tax credits. So this is important on why to decide why you should or why you shouldn't. Some people are not taxable enough to be in a corporation. For example, let's say your farm is profiting $20,000 a year net after expenses. Well, every individual taxpayer has a $13,000 personal exemption amount. So if you're in a partnership, you can earn $26,000 tax-free without paying a penny. Well, if you have that in the corporation, you're still paying tax on $26,000, where if it wasn't in the corporation, then it would be tax-free. There are some minimization strategies on this that get with a tax provider that can show you the best of both worlds, where you can actually get some tax-free money from your corporation using the personal tax credits. Liability may not be completely limited. This is something I will forward this on to your lawyer and have you have a conversation with your lawyer about this. But there's this old wives' tale that if I incorporate, I'm not personally liable anymore. My company is. Well, who owns your company? Who are the shareholders in the company, right? So there is some personal liability, just not as much as it would be if it were not in a corporation. I recommend that you speak with a lawyer regarding this point, just to find out exactly what your liability amount would be. And the other part is closing. It's more difficult. You know how easy it is to go up and start one? Well, shutting her down is very, it's a lot more easy than it was to start, we'll put it that way. At that point, you're cashing in your chips. Every time you cash in your chips, the government will usually expect their share. It's really easy to open, but it's a lot more complicated. Usually a phase out is what a lot of tax providers may recommend, where if you have an idea that you want to transfer it to your kids or you're going to dissolve it completely, try to have a 1 or 2 year window to give the accountant or tax provider so that they can phase you out of it, which will minimize your tax implication. All right, let's talk a little bit now about updating your the updates that have come through that will impact your 2019 return. I will suggest that some of these updates, you talk a little bit to your tax provider or accountant about. The first one is the home buyer's plan. Those amounts have changed. This is where someone can purchase a home and get a personal tax deduction in the year they purchased their home. So if you bought a home in 2019, those amounts have been adjusted. So make sure that if you did buy a home in 2019, you advise your tax advisor of that, or your accountant, because that matters. Excuse me. A lot of you guys know this one already, but I will remind you. There is an incentive on the climate provision on your personal tax return. So make sure that you're getting the credits on that and the incentives that are available. This one, I can tell you it falls off the radar a little bit more in Eastern Canada than it probably does in Western Canada. But that being said, you may not be able to know what it looks like on your tax return, but make sure that your provider is familiar with it and has automatically put that through on your tax return. It's not something that will automatically come up. So this is important and easy to get missed. So I explained a little bit about the small business tax rate. So the small business tax rate is basically income within a corporation. Okay, so there are certain amounts that you're allowed up to $500,000 of net profit would be taxed at this rate that you see on the screen. Any more than that amount, and then you're taxed kind of a lot more aggressively, closer to the 50% number. So this is where you pay, and some of you already are familiar with this because you've had conversations with your accountant, or your accountant's had conversations with you on this. But if you are one of those larger profiting farms, your accountant or tax provider will always be struggling to get you under that small business tax rate, because the tax triples, almost quadruples above that amount. So it's important that you kind of work within that small business tax rate and do everything you can to be taxable to that amount and never more than that amount, by using deferrals and all those strategies that your tax advisor will suggest to you or will put into effect to keep you safe. This is a new one. Some of you may or may not know of this, so I wanted to point this out. For years, people have been like, well, I'm going to buy a truck this year. And what's happened was the government will use what's called the half-year rules. So you're not going to be able to get the expense that you thought you would by buying a farm truck that year, for example. But so long as you purchased after November 21st, 2018, you're going to be allowed to claim 150% of the normal CCA rate in the year of purchase. So that's 3 times the amount you used to be able to use as an expense. It used to be 50%, so triple the rate, whereas before, purchasing a farm truck in a year where you were highly taxable, yeah, there would be a little bit of a tax benefit, but not as much as you think because you're spending $100,000 on a farm truck. In that year, you probably you'd only be able to use 50% of what you normally would be able to use. Well, now you can use 150% of that expense. So that's important, okay? I'll try to explain this in a way that you guys can understand, and I'll use round numbers so that you can understand it. So let's say you buy a truck that's $100,000. The normal CCA rate of claim is 30%, okay? So normally, in most years, you would get a $30,000 CCA expense. The CCA claim, you are only allowed to have made and claimed half in the year you purchased. So where normally you'd get a $30,000 expense on a truck, because it was the year you bought it, they'd only let you use 15 of it. You follow? Now, rather than using 50%, they're allowing you to use 150%, which would be $45,000, as opposed to the 15 that you were allowed to claim. I hope I went slow enough for you guys to understand that. But this is a new one and a goodie. Some people can now use purchasing, getting rid of the old one that's going to break down any day and costing you tons on repairs. Buying a truck is almost at the point of being a tax planning strategy a little bit, because you get to claim a much bigger number than you did before. We've got some free resources for you guys, where we've got some ebooks out there with information. We've got it's like an FBC Learn resource. It's an opportunity for to kind of get your own information at your own pace, whether it be payroll, whether it be audit triggers, tax tips. If you also own a small business, there's different tax tips for small businesses than there are for farms. You can all do it on your own pace. And the website's there, fbc.ca/learn. So you can go ahead and get that information as you're comfortable. Just to tell you a little bit in wrapping up here, how do we stack up, and how is it that we do all of these things for our clients? We work off of 4 pillars. The one is tax planning. The second one is the preparation, which is all the preparation of your personal returns, your corporate returns, government ag stability program, all those things. You have year-round consultation. So if you have a question and you don't want to get billed for the answer, you don't have to worry about that. You just pick up the phone and you'll get your answers. And we back it all up with audit representation, the only company in Canada who has a membership model and audit representation as part of their membership. What does that mean? We guarantee our return. That's what that means. If there's an error, we pay the penalty. We're the only company who will guarantee their work. So, with all of that being said, I will tell you this. If there's one thing that you get from this, I would like it to be this. Always get a second opinion on your accounting. Unless, it's an unbreakable relationship based on personal You don't really care whether they're doing things incorrectly. You don't really care whether you can get it better, because that personal relationship matters more to you than the possible money that could be saved on it. Then get a second opinion on your taxes. It's just like your personal health. It never hurts to get a second opinion on the financial health of your business. The worst case scenario, the second opinion will be, you know what? You're doing fine. You're in great shape. Don't stop doing what you're doing. And that's, in my mind, like the thing you could do in terms of worst case scenario of wasting your time. On the other hand, you may get advice on different things that can be done a little different. So if you haven't kind of asked questions or looked around for a little while, get a second opinion. It never hurts. You want to know, because it's money that you're costing yourself if it's not being produced properly. Okay? All right. Questions from the group?
Fantastic, Tony. So does anyone have any questions that they'd like to ask Tony while they're on the line here? I do have a couple of submitted ones here, sort of thing. So what I do have is, what deductions, I mean, you touched on this a little bit, Tony, but what deductions do you see commonly missed?
That's a great question. That's often the question that people are concerned, because, see, I always, so for example, leveling and draining your land. A number of times the government will force a repair of your land. And the government will usually provide a subsidy for it, and then you're on the hook for the rest of it. The renting off, like the electricity on the farm, sometimes electricity statements, hydro statements will be breaking out let's say, electricity for the house or the electricity for the barn, different things like that. I'd mentioned earlier that not necessarily the expenses, but the taxes, the HST, the PST, GST aren't broken out. And then when you're doing your input tax credits, you don't capture those amounts. That's common. And the biggest one for the farmer, the interest on the line of credit. That's the biggest one. Because what happens is, usually the interest on the line of credit that's on the operating account, that's a no-brainer. Everybody usually captures that amount. Mind you, it's different because the bank will only send you a statement once a year on what the interest on that line of credit is. So you've only got one shot to record that number, because if you don't take that notice and do something with it, then it will be something that you'll never remember to do. Because it's not like a credit card statement that shows you every month what your interest on that line of credit is. And then the other thing for farmers is if you're purchasing tools that cost less than $500, it can go in as a daily expense. You don't have to add that into your you don't have to kind of claim that on an annual basis. You don't have to have it as part of your CCA pool. So you can actually track it and put it down as an expense like you would fuel. So those are some of the big ones.
That's awesome. And the other one I had submitted here was in regards to what should be discussed with a new spouse or partner prior to sitting down with your accountant.
Okay, let me with your new spouse?
A spouse. So if you have a new partner, whether it's a personal relationship or even maybe a new business partner sort of thing, what conversation should happen even before you go into the accountant's office?
Well, first question is, and some of the conversations are uncomfortable, whether you're entering a business relationship with someone or a personal one, having a partnership agreement, which is akin to a prenup in personal relationship, where the rules are set out. There's no ambiguity. everybody knows what the rules of engagement are. And I would say that if I'm understanding the question correctly, that is probably the one thing over all the years I've done this, 13 now, I would say that that's the thing that comes back to bite people in the butt more than anything, is not having a legal partnership agreement. You've got to have one, because we'd love to think that the partnership is going to go on and on and on, and it's going to flourish and everything's going to be going great. But sometimes what accelerates those difficulties is not having clear rules of engagement put together.
Well, that's a great excerpt. Great point of view. Anything anyone would like to add? Do you have the Q&A at the bottom, or the chat as well, that you can ask Tony a question here? Also, again, in the goodie bag, there will be information so you can reach out to FBC.
Yeah, if I can just, because one of the things that I understand, Craig, is that sometimes these things are personal in nature, and there's questions that we really want to ask, but we don't feel like we can, just because they're personal in nature, right? It's hard to want to ask that question, especially when you don't know who else is listening. So I just want to let you guys know that on this call are two of our tax advisors and two of our people that one manages the northern region and the other one manages the southern. If you have questions and they're, you'd like to have more of a private discussion as opposed to this open forum, depending on the territory that you in, please reach out to the two individuals on your screen, and they will come and do a free tax consultation for you. Okay? And then you guys can get into conversations on a little bit more of a personal level, and also look into your situation individually, as opposed to kind of sharing it with the entire group. Just think that that's important.